Welcome to Wealth Matters podcast. Today, I want to talk about what are some of the assets which can sustain this recession caused by COVID-19 pandemic. Again, I always thought that the recession was coming for past couple of years, but this pandemic has made it go arrive much faster rate than it could have, right? So I have Matthew Ricciardella with me. He's the founder and CEO of Crystal View Capital. Matthew is responsible for the management and oversight of Fund 2, including investment strategy, fundraising, asset management, and operations. So welcome, Matthew, to Wealth Matters podcast. Uh, can you give us background about what you are up to right now?
Sure. First off, Alfish, thank you very much for having me today. I appreciate it. It's very nice to be with you. So, as we all know, we're in very interesting times and uncharted territory, as they say, in light of COVID-19 and trying to adapt to the new normal in terms of our business lives, our health, and our personal lives. So there's been some challenges. However, we also in our business see some opportunities. So it's quite we view this as an exciting time. So what we've been doing internally in our operations, as you know, we specialize in niche assets, two being manufactured housing communities and self-storage facilities. And we've adapted our operations to thrive through COVID-19. Some of you already know that these two asset classes are very resilient in nature.
Right.
They're very defensible, and they tend to perform actually better in down markets like we're going into right now, which I believe we're going to be in for the next 12, 24, or 36 months for that matter.
I see.
So during this down phase, our operations have not only done as well as pre-COVID-19, they're actually doing better in some cases.
I see. So, Matt, can you tell me how you ended up in real estate and how you found self-storage and mobile home parks?
Yes, I started in this business about 15 years ago
Oh, wow.
in the
Okay.
self-storage and manufactured housing community side. And the way I kind of ended up here is I surveyed the commercial real estate landscape and said, which properties produce the highest free cash flow? I was looking for cash flowing properties when I began my career because I thought that could sustain my lifestyle and I could grow my wealth through cash flow and appreciation. So time and time again, I found that these two property types produced more free cash flow than all the others. And I liked that they were defensible and that they tended to do better in down markets. You always hear the term, you take care of the downside and the upside will take care of itself. Well,
Yes.
now that's really playing out for us.
I see. So 15 years ago, wow. Yeah. So what was your first investment? Was it in self-storage or mobile home park?
My first mobile home park was actually in 2006. It was a mobile home park in Anaheim, California.
Really? Wow.
Yeah.
Orange County.
Orange County. It was I actually remember the address. It was 520 West Romney. It was a 8-unit mobile home park. And it was, just to give you an idea of how we look at deals, it's the same way as I did them back then. It's a value add approach. So lot rents at that particular community were about $300-400 below market on average. And the community was completely mismanaged. The roads had potholes in them up to your knee. There was no fencing, no security. And we went in and we completely revamped the appeal of that community. We put in new roads, new laundry and washer and dryer. We put in new fencing, and then we were able to increase rates, create value. And then within 3 years, I sold that park. And I sold it for almost double what I paid for it. So it was a good deal. And we follow the same approach today. It's just a lot larger scale.
That's a great start, though.
Yeah, it was a good start for me.
So let me ask you about this. How has your strategy in purchasing self-storage and this manufactured housing assets, benefited you during the pandemic?
Yeah, well, I think two things. One, I think we've been able to be in a good position through the pandemic. First off, because of the two property types that we're involved in and their defensive nature, they were deemed essential businesses, and we never closed down throughout the pandemic. We actually continued to rent units at our storage facilities through online channels because we had that infrastructure in place to do that. So our occupancies grew.
Okay.
And then the second part about it, where I think that we thrived throughout this, was our very, very hands-on asset management. We had our thumb on the pulse of everything during this pandemic. We had our thumb on the pulse of it prior to, but even more so now. So we would have Zoom meetings with our on-site managers on a daily basis from our corporate office. We implemented bonus and incentive structures for our on-site managers to ensure that they were collecting the rents that we needed to sustain.
Right.
We had daily conversations with our residents, believe it or not, talking about when are you going to pay? How is it going with your stimulus? And if you can't pay, we'd set up payment programs for them. So by doing all of that, we ensured that our collections were on track. We ensured that our occupancies grew, and it's proved out quite well for us.
That's great. So let's take self-storage, and then we'll go to mobile home parks.
Yeah.
So for self-storage, you said that you were able to rent out. So was it because of your operations or how you are marketing online?
Yeah, it's a great question. So yes, we have websites for every self-storage property that we own. There is a portal within that website where they could actually rent the unit right from the site.
Nice.
The manager will in turn put a lock on the unit that they're renting. They'll sign the rental agreement online via DocuSign, send it back in, and there never has to be that face-to-face interaction. So we're able to rent units without having that face-to-face. So that's one of the reasons why we thrived through COVID.
That's amazing. So pretty much hands off. And also, do you have on-site manager at these facilities, or are you able to control everything remotely, like remote locks, cameras, whatnot?
Well, we have remote cameras, but everything is, all of our properties are managed by on-site managers. Excuse me for a second. My lights are motion detected. So if I have to get up every 15 minutes, that's the reason why. So we have on-site managers at all of our properties, and they, in most cases, live on site as well. And they have an office on site, and they're communicating with the residents, and they're making the collection calls, talking to the tenants, ensuring that they're paying their rents. But yeah, through COVID, those managers didn't have to make face-to-face contact to continue renting units and ensuring that operations continued as normal.
And do you think self-storage would continually be like like a recession-resistant asset? Especially, people need roof to live, but would they keep storing their stuff?
Well, it's a complicated question. One thing that makes me feel more comfortable about the property type right now, what my concern always has been with storage has been oversupply. Since it's such a good business, you've got certain markets are oversaturated by storage product. But now, in light of COVID and the shutdowns and the lending markets being frozen, that development pipeline has essentially been cut off. So you've got a lack of new supply coming to market, which is going to allow existing facilities to gradually increase rents and to remain at strong occupancies. So we feel good about that for the near term.
And I'm glad that you brought up the oversupply. So do you focus on certain markets so that those markets will thrive, right? Because I'm pretty sure some markets already have oversupply, right, in self-storage or not.
Oh, absolutely. There's certain markets, and I'll give you a few of them. And unfortunately, we're in one of them. Dallas, Texas is a really
Yes.
market.
Yes.
Yeah.
Right
Another
now.
one Yeah, big time. So it's very challenging. You have to offer concessions in order to
Because
rent units, and there's a lot of new supply. But we're really outfish in secondary and tertiary markets where the REITs don't want to go, where there's
right,
really no new development. So we're somewhat insulated from an oversupply on the aggregate level across our portfolio. Yes, there's certain markets that we're in like Dallas, that we're having a little bit of a supply
yeah,
issue. However, we're still maintaining an 88% occupancy in that market. So
that's great.
it's not like we're getting killed, but you need to be conscious of oversupply in certain
Right.
stores.
And I love Dallas Fort Worth market, but it got so hard, Austin and Dallas, that people just
Yeah,
started building left and right.
yeah,
Same thing with multifamily now.
absolutely. And I think what you're seeing, that to answer the first part of your question, the demand is growing because
Yes.
there's this common theme of downsizing taking place across the US economy right
Yes.
now. So the people are moving from, let's call it, their multifamily apartments, and they're going into more affordable housing. That creates the demand for storage.
Right.
Restaurants that now have to go down to 50% capacity, where are they going to put those tables and
Oh,
chairs?
yes.
They need to go into storages. Offices, I'm sure you've heard
Oh, yeah.
a lot
Yeah.
of people now are, they enjoy
Yeah.
working from home, and maybe after COVID they're not going to even go back to the office. So where does
Yeah.
all that furniture go? So storage, in my opinion, is going to be a beneficiary of the downsizing trend that's going to happen in the United States in the coming months and years.
That's great. So let's pick up mobile home park.
Yeah.
Which markets are you focused on right now? And uh, has any of the evictions, did you have to do any eviction, and has any of this federal ruling affected evictions?
Yeah, it has. Every state is different.
Right.
There's moratoriums in certain states for evictions where you can't do that. They're now beginning to burn off. Wisconsin's one that we have over 1,000 sites in. The moratorium has burnt off, so we're going to continue our eviction process. Most folks didn't take advantage of the moratorium. I think they were smart and did the right thing for their family, because it only deferred the inevitable. It's not like they won't be evicted. We just couldn't
Right.
evict them during COVID. So, by having that connection between our on-site managers and our residents, we still were able to collect rents. And I would tell you, in our manufactured housing portfolio, across the board, our collections were about 92% over the past 2 months. So we're really happy with that performance.
That's great. And so for the mobile home park, when you are evaluating a deal,
Yeah,
what do you look at? Do you also look at same way tertiary market, secondary
yeah.
market, and is there anything else go into the research for them from the market perspective?
Yeah, yeah. So geography wise, we don't pigeonhole ourselves to a certain geographical region. We're really value driven. So we'll go where the deal is. We're willing to be, and that's why we're scattered across the United States. We've got
Okay.
stuff on the East Coast, we've got stuff in the Northwest, we've got stuff down in Texas, and we've got a concentration in the Midwest. So we'll go anywhere throughout the country. What we're looking for are certain deal profiles, being mostly inefficient operations. A lot of times that's a mom and pop owner
Right.
operator. We're looking for a fair price. We're looking for the ability to create value. Most times that is occupancies are suffering, and we could come in and increase occupancies. Expenses are out of whack. We come in and we operate more lean and cut our expenses and drive net operating income. And also rents are below market, where we could step in, make improvements to the property, whether that be a storage or a manufactured
Hmm.
housing community. And because of those improvements, we could push rents higher and justify that. And by doing those things, we're able to really drive valuations and free cash flow for our partners.
So can you give an example of how you are able to cut expenses and stay
Sure.
lean?
Sure. I'll give you an example on a deal that we're doing right now. So we bought a manufactured housing community in Louisville, Kentucky,
Okay.
and we bought that community in February of this year.
Oh, wow.
Um,
Right before.
right before COVID, we
Wow.
bought this deal off market. I'll tell you an interesting story too, and this kind of lends to what we do by buying our deals and sourcing them off market by not competing with the rest of the
Right.
buyers that
That's
are out there.
important at this in this market, especially when uh, everyone is competing for the same deal and cap rates have been compressing.
Absolutely. So we bought this deal direct to the ownership. We bought it for $7 million. The owner actually told me, he said, "Hey, I've got offers above $9 million, but we feel comfortable with you, so we're going to sell it to you." And I thought to myself, well, they're probably just blowing smoke. I don't know if I really buy that. Lo and behold, we buy the deal. We close on it in February. A week later, I get a phone call, and it's a buyer who said, "I don't know how you got it, but I offered 9.5 million on this deal."
Whoa.
And I said, "Wow, the owner wasn't kidding." And so let me tell you how we're going to cut expenses to create value on that particular transaction. There is a master meter for water and sewer.
Mhm.
The water and sewer bill on average is about $20,000 per month.
Oh, wow.
What we're going to do is we're going to install individual meters on each individual unit throughout that community. There is about 253 occupied lots right now.
Oh, okay.
So now we're going to be able to pass through that $20,000 water and sewer bill to the individual residents. Now, if you look at that on a cap rate basis, that's $240,000
Right.
of NOI
Huge.
that we've added. Now, think about what that's worth at,
If
let's call
it's
it a 6 cap.
right,
That's about $4 million of
right,
value, give or take, that's created by this one activity that's going to cost us about $150,000. So
right.
that's how we trim expenses to create value and drive cash flow.
Got it. And to do something like that, do you have to get approval from the city, and do you have to notify the tenants, and how do you do that?
Yeah, we notify the residents. We checked with the local municipalities to make sure it's allowable. Some states, there's restrictions in doing that. This particular one didn't have it. So without the restrictions, we engaged a third party to come out, install all those meters. There's actually a device that reads them remotely. So it
Right.
will tell us their usage, and then we bill per the city's guidelines based upon usage, and then we will bill them with their rental statement each month. And
Got
then
it.
we will collect their rent, we'll collect their utility reimbursement, and then we'll pay the utility provider. So we
I
pass through, in essence, that expense.
so still the utility and everything is on the business's name, not resident's name.
That's right.
And are those residents, they are lot renters, or they or the trailers are owned by the business and they rent the entire home?
In this particular community, they're 100% owned by the residents. So
Nice.
we don't own any homes in this community. Now we're going to start buying homes because
Right.
we're going to fill vacant spaces. We've got about 60 vacant sites here, Alfish.
Nice.
So over time, and it's a very strong market. I'll tell you, we've got a waiting list of people that want to buy homes from us. So we're
Wow.
now in the process of bringing homes in. We're going to fill those vacant lots and take this property from, let's call it a 80% occupancy to 95% in the next few years. And now it's really going to be worth a lot more.
Yeah, yeah, and that I'm actually looking at a mobile home park, and that's why I asked those questions. That
Yeah.
how are you going? But having all 100% tenant-owned homes, that's amazing.
Yeah, it makes operations a lot
Oh
easier, a lot
yes,
cleaner.
yes,
So
less maintenance, and yeah, no,
yeah,
that's
we're
great.
excited.
So
Yeah.
you just mentioned that you purchased this property in February. Are you still looking for deals in self-storage and mobile home park at this point?
Absolutely. In fact, we just closed on another park on May 1st in Iowa.
Congrats, man. That
Yeah, thank you. And we've got about $17 million of transactions that we're going to be closing on within the next 60 days. We've got another closing coming up next week, which is a community down in Texas. So we are aggressively pursuing acquisitions. What we're finding is the capital markets are frozen because of
yes,
COVID,
true.
and we're very liquid. So we're able to come in and buy deals for cash. And that's allowing us to buy at attractive valuations because a lot of buyers aren't in that position.
Right.
So it's creating an opportunity for us in the near term.
Yeah, and actually that was going to be my question. How are you able to continue to purchase during this pandemic? So you
Well,
answered kind of liquidity, but what else? How are you still actively working with brokers, and how are you, keeping in touch and trying to get all this sorted out?
yeah, yeah, it's interesting. Well, first off, mostly, and I will say 92% of our deals are sourced off market. So there
Okay.
really is no broker involved. However, the brokerage community does know that we are a player in both
Right.
these asset classes. So they're constantly bringing us deals. We're always underwriting those deals. Whether they're on market or off market, we're agnostic to that. We're just looking for the
Right.
best deal at any given time. It just so happens that 9 times out of 10, it's off market, which gives us the most attractive value. So we're buying those type of deals. But it is a little interesting with the closures that take place. A lot of the title companies are partially closed, so you have to
Yes.
become resourceful to get these deals done. Sellers need to be motivated to work with you throughout the close down. It's a little bit harder for travel, to get to
Yes.
the
Oh, yeah.
properties. But we're able to navigate through all of that, and we're really excited about some of the deals we're adding to our portfolio.
That's great. So, can you talk about this latest deal you closed in Ohio on May 1st? What are the numbers, and
Yeah,
what are you planning to do?
yeah, absolutely. So it was in Iowa.
Oh, sorry.
It's right outside of Cedar Rapids,
Okay.
which is a relatively strong market, about
Yeah.
150,000 MSA. When we bought it, it was classic mom and pop owner operated, a lot of inefficiencies, really no on-site presence. The owner didn't spend much time there, and the manager was really doing some things that they shouldn't do. So we took over, we got rid of that manager. We brought in our own management team, which has already been with us, and we know that's a proven performer. They're now living there. So the plan here is, Alfish, we have about 100 occupied lots. There's 142 lots in total and another very strong market. So we're going to bring homes in. We've actually already purchased a home, which we're going to bring to the site. We're going to buy in the next 5 years, 3, 4, 5 years, let's call it 40 homes. We're going to fill those vacant sites. We're going to make some improvements, some road work, things of that sort. But I'll tell you what's compelling about this community as well. The average lot rent here is $240 a month. The
Okay.
market is $350. So we've got a
Wow,
lot
that's
of room.
huge. Yeah.
Yeah, we've got a lot of room to bring rents to market. So we're excited about this deal, and we're really glad we brought it into the portfolio.
Got it. And when you acquire these homes for filling the vacancy, do you acquire them on cash, or do you go through that 21st mortgage program or something?
We were doing the cash program with 21st Mortgage. I'll tell you, there's a lot of hidden fees there. I don't want to speak poorly upon anyone. That is
Right.
a good group. We do buy homes from them. But given our cash position, we've just elected to buy
Right.
homes
Right.
cash,
Which
bring them
makes
in
sense.
there, and then sell them.
Yeah,
So
yeah. If you
that's
are
been
able
working
to
well for us.
acquire, $7 to $10 million properties for cash, why would you go with someone else, right?
Right. Why buy home? Why
Right.
finance
Yeah,
homes that
30,
cost you
40,000.
30,000?
Yeah,
Yeah.
exactly.
Yeah.
Yeah, and so when you get those homes, do you rent them out, or do you go with lease option or rent to own or something like that?
Well, our first preference is to
Okay,
sell them
that
outright.
makes it easier.
Yeah.
Yeah.
If we can't do that, we'll check with the state guidelines to ensure that it's allowable. If it is, we'll do the rent to own option. Our absolute last resort is a rental, because
Right.
with a rental home, you're responsible for the repairs and maintenance
Yes. Yeah.
on that particular home. And that's not a business we want to be in.
No, that's a great strategy.
Yeah.
So how have you driven performance during this time?
Yeah, I think, and I mentioned this earlier, the way we've really driven performance has been our hands-on asset management. And now it's been ultra hands-on asset management. So we have weekly calls with every one of our managers at our
Okay.
on-site facilities. And we talk to them. How's it going? How are collections going? What's working? What's not working? And it's a chance for them to network with one another and to discuss what's been working for them and what's been driving their success. So we really have this hands-on approach with our on-site managers, and our on-site managers have a hands-on approach with our residents and our tenants. And by doing that, we're able to maximize performance, and performance being, of course, collections. We're at about 92%, and maintaining or growing occupancy, which we've been successful in doing throughout COVID. So it's really just having your thumb on the pulse and not outsourcing any of the management at all has really contributed to our success.
So the management side, pretty much those are your employees and not a third party management.
Yeah, we oversee everything. A lot of managers, such as myself, that manage private equity real estate funds, they'll outsource to third party groups. We don't do any of that because, quite frankly, I don't believe anyone can do it better than us. And not only that, who's going to care more about your investments than you?
Right. Yeah.
So,
who has skin in the game, right?
Yeah. Who has? And I have a lot of my own money into these funds.
Exactly.
So believe me, I've got the expertise and the management prowess to do it. Why in the world would I let somebody else take a chance at it?
Right. No, I get it. So let's talk about overall impact from COVID-19. What do you see would be the impact of coronavirus on overall real estate?
Well, to answer that question, I think it's going to depend, and it's going to depend on a few things. One, geography. I think certain geographies are going to be more impacted than others. Like where you are, ultra urban infill locations, San Francisco, New York, perhaps Chicago, Detroit, some of these type of cities. I think you're going to see a bit of an exodus of population, people coming into these more suburban locations, more rural locations that don't want their families to necessarily be exposed to coronavirus.
Right.
So I think that is going to impact property values in those particular locations. The other thing is property sector. Each property sector is going to be impacted differently. Now, I'm in Las Vegas. Take a look at hospitality. I mean, the entire strip is closed down, and it's been that way for 60 days. Right. If that continues, how do you think hotels are going to do in this city? And not only Vegas, many cities.
Many, yeah. Airbnb business. Look at Airbnb business.
Yeah. Or you look at retail, or you look at office. I think you're going to see a major fall off in values and occupancies because of COVID. Now, on the flip side, look at what we do. I think we're going to be more of a beneficiary of COVID because people want to come to more rural locations. Think of the setup of a mobile home community. They have their own home, their own yard. They're completely separated from everyone else. They don't have to interact with anyone like they would in an apartment building under one roof.
Yeah, and you still pay almost similar rent.
Yeah. And storage, because of the downsizing, I think will be a beneficiary there. So every property type and every geographical region, I think, is going to be impacted in different ways. But by and large, again, the hospitality, the retail, and the office sectors, I think you're going to see some distress.
I agree. So would you be changing any business or investment strategy after coronavirus?
No, I think we're going to focus more on what we do. I will say this, focus on what we do well. We are targeting owners of storage facilities that don't have an online presence, because as opposed to how we've been able to rent units during COVID using online channels, a lot of owner operators have not, because they didn't have the technological infrastructure in place to do that. They still relied on the face-to-face contact to sign a rental agreement and to rent that unit. And either their manager or that prospective tenant couldn't get comfortable with that. So they came to an operator like us where it could be done online. So I think the change we would make is focusing on finding those type of owner operators and then implementing our efficiencies and our technological infrastructure to maximize operations on the online channels and the rentals that come from that.
Oh, this is great. Thank you. Let's take a
Yeah,
quick break.
sure.
Welcome back to Wealth Matters Podcast. Matt, this is the last portion of the show, and we go with fire round. So, what is the favorite real estate or finance or any other personal development related book?
Yeah, I'll tell you two books that have really had an influence on my investing strategy and some of my personal beliefs surrounding real estate and investing. One is Am I Being Too Subtle by Sam Zell. I
Oh,
don't know if
okay.
you've ever
I
read
have
it.
not read that. I got to put it in my list.
Highly recommend it. I will say this, Sam is the chairman of Equity Lifestyle Properties, along with Equity Residential. He is the single largest manufactured housing owner in the United States.
Oh, wow.
Yeah.
Wow.
Through his REIT, ELS, which is
Yeah.
Equity Lifestyle Properties. And, just had a profound impact on my life. I've actually met him once.
Nice.
And he was nice enough to take a couple minutes to speak with me.
Yeah.
So that was really a highlight for me. Second book is The Snowball by Alice Schroeder. It's a biography on Warren Buffett's life.
Yeah.
I've really adopted his investing philosophies. Rule number 1, don't lose money. Rule number 2, don't forget about rule number 1. So if you start there, I think you're in a good spot.
Yes.
Highly recommend those two books.
Okay. Awesome. Yeah. I have read The Snowball, and it's a great book. Actually, I got to revisit. It's been like almost, I think it's been a while since I last read it. So yes.
I've read it several times. Yes. I've listened to it on Audible, and going back to it 3, 4, 5 times, you pick up new things
exactly.
that you missed the first time.
It's been a while, so I got to go back.
Yeah.
Any tool or website you can't live without or you highly recommend?
I'll tell you, I'm pretty old-fashioned. I'm not that old, but I am old-fashioned, and I really believe in face-to-face contact. Right now, we can't have that, so I'm resorting to the telephone. And I think what I can't live without is not necessarily a website, but it's my phone, because my phone has really been the driver of the success of this company. And the reason for that is it's really a relationship business at the end of the day, Alfish. And by me making contact and speaking with these owners and speaking with my managers and speaking with the corporate project managers here in my office in Las Vegas has really allowed me to influence people. It's allowed me to kind of convey the message that I'm wanting to convey to our owners, and that being that, or not our owners, but potential owners, that being that, hey, we're an operator, we're willing to pay cash, we'll move quickly, and you don't have to deal with anyone else, and we'll make that process simple. I don't know how to convey that message via email, or I don't know how to encourage our managers via email. I guess you can, but nothing compares to face-to-face. And now that we can't have that, I think the phone's the next best thing. So I can't live without a phone.
That's awesome. So last question, how do you give back?
Yeah, my wife and I this is something that's near and dear to us, and we're starting to give back more and more as our success has increased over the past several years. I'll tell you something we did recently in all of our properties. We have about 32 properties throughout our portfolios and our funds, and that I own personally. And I told each and every one of those on-site managers, I want you to go out into your community and find a cause that you think is doing something that's positive for the community and helping people go through COVID. It might be local churches, could be food banks, clothing for kids, tutor help for children, things of that sort. And we're giving, anywhere from $300 to $800 to every one of those causes, to every one of the properties in all these communities throughout the country. So we felt really good about being able to do that. And at the end of the day, it's about giving back, and it's about
Yes,
contributing,
yes,
because
absolutely.
you could become wealthier and wealthier, but that fulfillment is really only achieved when you give back.
I agree. Thank you so much, Matt. We are at the end of the podcast. How can my listeners reach out to you?
Anybody could reach me via email, matr@crystalviewcapital.com. Please visit our website, www.crystalviewcapital.com. You could see our portfolio on there, a little bit more about the investment strategy. If you're interested in investing, there's a tab, fill it out. We'll send you our corporate deck. You can take a look at that. And we'd be really happy to speak with you and see if we'd be a good fit for your investment goals.
Perfect. Take care, Matt. And everyone, thank you for listening.
Thank you for your time, Alfesh. I appreciate it.
You're welcome.